Congratulations, you've just started to save for a house deposit. Now, depending on where you are along in that journey, you might be asking the question, where should I put these savings? Should I invest that money in the share market, or should I keep it safe in a high interest cash account? Both are great questions. This video will go through the key considerations to help you decide which is best for you. Let's get into it. Perhaps the biggest consideration when looking at saving for your house deposit is your time frame. Over long periods of time, the effect of compounding can lead to significant growth in what you've saved. This can give your deposit a real boost and cut years off your savings journey. At the same time, investing does involve risk. In this instance, we're talking about the risk that the value of your investment will decline. And if your investment declines when you need to withdraw your house deposit, you could be in hot water. For example, the ASX 200 returned just under 9% per annum in the last 30 years to the end of 2023. If you had been an investor in a low-cost ETF that tracked the index over that period, your investment would have increased 12-fold. So it sounds like a no-brainer to put your deposit in the share market. But in those 30 years, 5 yielded negative returns. So if you were forced to sell in any of those years, you would have given up some unrealized capital gains. And if you'd planned to buy a house in a year's time and invested inside of one of those years, your hard-earned house deposit would have lost value. Consider whether or not, if you start investing your deposit today, you have the flexibility to ride out investment volatility. If you can afford to wait out a market downturn because your time frame is 5 years or longer, then shares might be the best way to build up your deposit. If not, you can always consider another asset class that carries less risk. For example, Australian bonds have only yielded negative returns in 3 of the last 30 years. This may make them more suitable for shorter term holdings, but it does mean you'll probably achieve lower returns. In this case, Australian bonds returned an average of 5.5% per annum in the last 30 years. Finally, if you're looking to put down a deposit in the really short term, say in the next few months, you want to keep that deposit as safe as possible. In this instance, it might be worth considering a high interest cash account. That way you can sleep soundly knowing that your deposit won't fall in value. Once accounting for your time frame, consider your personal liquidity needs. ETFs and shares on the ASX are generally considered to be liquid. You can sell your investments and receive the cash within 2 business days. But cash is still king when it comes to liquidity. Money in a cash account can be accessed immediately. If you think that some of your house deposit might be needed for upcoming expenses, consider holding that portion as cash for easy access. This is also a good time to consider an emergency fund if you don't already have one. Emergency funds are savings held as cash that can be used in the case of an emergency. If you need to buy a new car when your old one breaks down, for example, you can draw from your emergency fund. In this way, you won't have to dip into the money you've set aside for your future home. Another consideration is expected returns and inflation. Cash accounts often yield less than inflation, and that means the real purchasing power of your savings will fall over time. To help prevent this, look at the interest you're receiving on a cash account and compare it to the inflation rate. CPI inflation was 4.1% in the last quarter of 2023. Although the targeted range is usually between 2 to 3% per annum. If your cash is not yielding at least this amount, you might need to budget in more savings or more time to reach your house deposit goal. One of the benefits of investing is that it can offer returns above inflation, which can help offset the loss of purchasing power over time. Again, time frame will help inform this factor. Losing 0.5% to inflation over a 12-month period isn't likely to stop you from putting down your deposit, but losing that amount over a number of years can add up. And don't forget to factor in taxes and fees when considering returns from investments. Interest, dividends, and capital gains are all taxable, and fees can compound over time in the same way as your investments. The Australian government's Money Smart website contains a compound interest calculator, which is a useful tool showing you how an initial deposit and regular savings can grow over time, assuming a consistent average annual rate of return. You can find that resource linked in the description of this video. These are the key considerations to take into account, but also keep in mind that you don't have to do one or the other. There's no reason why you can't keep your deposit as a mix of investment and cash. You may also want to consider seeking personalized advice from a financial advisor or tax professional. For more content that will help set you up for a lifelong financial journey, subscribe to the channel. Thanks for watching, and we'll see you next time.